Hello everyone. Let's first test whether the video is working or not and then we'll start. Okay, it's working. So last time we were doing the July monthly magazine and we completed few portion of economics up till gig workers and gig economy, and today we'll do the complete economy without much ado. Let's start. There's a lot to cover and a lot were left. So we'll do from portfolio, foreign portfolio investment up till electric freight vehicles, and then next class we'll revise. Okay, so let's start this. I'll try to be more regular from now on. I'm extremely sorry the way I just left, but yeah, let's be. Today's date is 16th September 23. Foreign portfolio investment. Security and Exchange Board of India (SEBI) released the consultation paper on a framework for mandating additional disclosures additional disclosures from identified high-risk foreign portfolio investors. Who did? SEBI did. There has been This has been done to enhance trust in the Indian securities market by mandating additional disclosures around ownership and of economic interest in high-risk FPIs. To minimize any inconvenience to the FPI ecosystem, only a limited number of objectively identified high-risk FPIs will be mandated to provide such additional disclosures. So first of all, what is FPI? FPI regime came as a harmonized route of foreign investment in India, merging the two existing modes of investment, that is, foreign institutional investors (FII) and qualified foreign investors (QFI). So FPI is fluctuating in nature. FPI has fluctuated drastically in the past decade. The net FPI in India was to the tune of 1.65 lakh crores, close to 0.6% of GDP. FPI 0.6% of GDP. Now, what are the categories of FPI? First, that is government and government related security investors such as central banks, sovereign wealth funds, etc. Then category 2, funds which are broad based and appropriately regulated and includes mutual funds, investment trusts, insurance companies, banks, asset management companies, broker dealers, pension funds, etc. Then there is category 3, endowments, charitable societies, corporate bodies, trust, family offices and individuals. Now existing provisions for FPIs in India regulated by SEBI. Under SEBI FPI regulations, SEBI has prescribed certain limits on the investment that FPIs can make in Indian securities. Then legislative provision. FEMA, Foreign Exchange Management Act 1999 is the primary legislation governing FPI in India. Then Preventing of Money Laundering Act 2002 (PMLA) is the Prevention of Money Laundering Maintenance of Records 2005 rules. Okay. So what are the issues identified with FPIs? Concentrated investment. Some FPIs have been observed to concentrate a substantial portion of their portfolio in a single company. It raises the concern and possibility that the promoters of such corporate groups or other investors could be using FPI to circumvent regulatory requirements such as maintaining minimum public shareholdings. It also increases the risk of price manipulation of listed companies. Then second is circumvent of Press Note 3 PN3 stipulations. PN3 requires that an entity of a country that shares a land border with India can invest only under the government route. Since PN3 does not apply to FPI investments, FPI route can potentially be misguided to circumvent the stipulations of PN3. Failure to disclose related party transactions (RPTs). RPTs are arrangements or deals between entities with a common interest or relationship, like companies. Recently, the Hindenburg report raised the concern of non-disclosures of RPTs. Hindenburg report raised the concern of non-disclosure of RPTs. The framework of FPI allows indirect circumventing of RPT disclosure requirements. Now, comparison. Now, comparison of FDI and FPI. FDI refers to investment made by foreign investors to obtain a substantial interest in the enterprise located in different country, while FPI refers to investing in financial assets of a foreign country, such as stocks or bonds available on an exchange. Role of investors: active investor and then passive investor. Direct investment, indirect investment. High control, very low control. Long term investment, short term investment. Physical assets of the foreign country, financial assets of the foreign country. Difficult, relatively easy, stable, volatile. There's one more thing. If the investment is more than 10% of the assets of the company, it is an FDI. If it's less than 10% of the assets of the company, it's an FPI. Now, SEBI's proposal for FPI regulations. Categorization of FPI. FPI may be categorized as low risk FPIs, government and related entities such as central banks, sovereign wealth funds, etc. Then moderate risk FPIs, pension funds of public retail funds with widespread dispersed investors in such funds. High risk FPIs, all other FPIs. Then enhanced transparency measures for high risk FPIs. For fully identifying all holders of ownership, disclosure of economic and control rights may be mandated for certain objectively identified high risk FPIs. Additional disclosure. For requiring additional disclosures, the above risk categorization is to be coupled with either the quantum of concentrated investment by FPIs or the size of overall assets under management. High risk FPIs holding more than 50% of the AUM in a single corporate group would be required to comply with the additional disclosure requirements. High risk FPIs with an overall holding in Indian equity markets or over 25,000 crore will be required to comply with the new disclosure requirements. Now, corporate debt market. Recently, SEBI released a framework for rolling out the Corporate Debt Market Development Fund. So, CDMDF established an alternate investment fund will purchase investment grade corporate debt securities during market stress. Alternate investment fund refers to any privately pooled fund established or incorporated in India for investing, These funds are collected from sophisticated investors such as angel investors, venture capitalists, etc. Investment grade refers to the quality of a company's credit. The company may be rated at BBB or higher to be considered an investment grade issue. During market stress, the debt market faces redemption pressures in the open market, especially schemes with long maturity periods. CDMDF will help market by providing liquidity access in such times. The fund aims to emulate the RBI's liquidity support for banks in the context of corporate debt market. Contribution. Contribution to the fund shall be mandatory for specified debt-oriented MF schemes and asset management companies. Initially 15 years, it can be extended as per SEBI's mandate. Corporate debt market. The debt market, also called the bond market, fixed income market, or credit market, is the collective name given to all trades and issues of debt securities. The market can be broadly divided into government debt market and corporate debt market. Companies issue corporate bonds to finance current operations, expand product lines, or open new manufacturing facilities. Corporate bonds usually describe longer term debt instruments that provide a maturity of at least 1 year. SEBI has a jurisdiction of over corporate debt market. The regulatory jurisdiction between SEBI and RBI was clarified in 2000 by an amendment to the Securities Contract Regulations Act 1956. Under this, RBI's regulatory jurisdiction includes money market and government securities. Status of the market in India: outstanding corporate bonds in India as a percentage of GDP stood around 17% in March 2022. The same figures for other emerging Asian economies are much higher. South Korea more than 80%, Malaysia more than 50%, China has more than 40%, and we have only 17%. Now, significance of corporate debt market. Investment needs to shift from consumption driven to an investment led economy, as emphasized by the Economic Survey 2018-19. Efficient allocation of resources. Additional avenues for corporates to raise funds cost effectively and reduce reliance on bank finances. Health of corporate balance sheet. Reduce corporate reliance on external commercial borrowings, which is subject to volatility in the international market. Financial inclusion of SMEs. It can lower the cost of the capital for SMEs and ensure transparency in their functioning due to greater external scrutiny. Financial stability. Address asset liability mismatch of banks concerning long term capital finances and spreading credit risk across the economy. Issues with the corporate debt market in India. Credit rating. Systematic flaws in the credit rating process by credit rating agencies, such as lack of standardization, transparency, etc., it often results in opportunistic rating shopping by issuers and the loss of trust by retail investors to invest in the bond market. Mode of issuance. Most corporate bonds are issued for select market participants and are not open to the public, thus hindering the penetration of corporate debt market. Liquidity constraints. Limited issuer and investor base, absence of standardized market indicators, etc., result in the absence of a liquid corporate bond market, dominance of government securities. According to Clearance Corporation of India, CCI and SEBI, March 2022, outstanding corporate debts were just around 30% of the outstanding government securities. Way forward, transform credit rating agencies and credit rating process to ensure greater transparency. All entities offering credit rating as a service must be registered as a CRA. All credit ratings once obtained must compulsorily be published to avoid rating shopping by issuers. Improve the availability of market information. Encourage trusted issuers such as banks, financial institutions, etc., to issue bonds across maturities. Develop debt market index on the lines of equity indices like BSE, Sensex, and Nifty 50. Broaden investor base. Encourage participation of retail investors, qualified institutional investors, among others, by providing additional tax breaks for interest income. Streamline banks and financial institutions' bankruptcy and insolvency regulation process to boost investor confidence. That is done. Now, the Mines and Minerals Development and Regulation Amendment Bill 2023. So it's a bill. Recently, Parliament passed the Mines and Minerals Streamline Banks and Financial Institutions Bankruptcy and Insolvency Regulation. Right. Now, more on the news, it will amend the Mines and Minerals Development and Regulation MMDR Act 1957. MMDR was comprehensively amended in 2015 to bring several reforms in the mineral sector, such as establishing the District Mineral Foundation and National Mineral Exploitation Trust. Act was further amended in 2016, 2020, 2021 to bring further reforms in the sector, such as removing the distinction between captive and merchant mines, removing the restrictions on the transfer of mineral concessions. What are critical minerals? These are minerals that are essential for economic development and national security. Deep seated minerals. These minerals are gold, silver, copper, zinc, lead, nickel, cobalt, platinum, group of minerals, diamonds, etc., which are deposited deep in the earth's crust. The need for further reforms. Increasing the exploration of mining and critical minerals have gained significance given India's commitment towards energy transition and achieving net zero emissions by 2070. FDI received in mining sector. FDI received in the mining sector is limited. This is despite the automatic route allowing 100% FDI in the mining and exploration sector. Now, key features of the bill: introduction of exploration license for deep-seated and critical minerals to undertake reconnaissance. Let's see how this word is pronounced. Reconnaissance. It is in military operations. Okay. Reconnaissance. To undertake reconnaissance and prospecting operations for critical and deep-seated minerals. The exploration license EL will be granted through an auction for minerals specified in the 7th schedule of the MMDR Act. The seventh schedule contains 29 minerals, including lithium bearing, copper bearing, potash, and zinc bearing minerals. Validity of EL for 5 years. Request for an extension for up to 2 years can be applied to the state government. Mining lease. The blocks explored by the license would be auctioned for mining lease within the prescribed timeline, which will fetch better revenue to the state governments. The exploration agency shall be entitled to a share in the auction premium payable by the mining lease holder. Omission of 6 minerals from the list of 12 atomic minerals. Omission minerals. From the list of 12 atomic minerals specified in the Part B of the first schedule of the MMDR Act, it proposes to omit 6 minerals. These minerals have various applications in space industry, electronics, communication, etc., and are critical in the net zero transmission emission commitment of India. Which are the omitted minerals? Beryl and other beryllium bearing minerals, lithium bearing minerals, niobium, titanium, tantalum, and zirconium. Opening to private sector. The inclusion of minerals in the list of atomic minerals reserved their mining and exploration to government entities. Upon removing these minerals from the said list, exploration and mining of these minerals will also be open to the private sector. Open to private sector. Empowering central government to exclusively auction mineral concessions for critical minerals. The role of central government. The amendment empowers the central government to exclusively auction mining leases and composite licenses for certain critical minerals listed in new Part D of the first schedule of the MMDR Act. Part D of the first schedule includes critical minerals such as tungsten, cadmium, minerals of rare earth group, such as tungsten, cadmium, minerals of the rare earths group, fertilizer minerals, minerals being removed from the list of atomic minerals. Role of state government. Even though the central government would conduct the auction, the mining lease or the composite license for these minerals to the successful bidders will only be granted by the state government. The auction premium and other statutory payments shall continue to be received by the state government. Implications. Foreign investment in entrepreneurship. This amendment is expected to provide a conducive legal environment for attracting FDI and junior mining companies in the country. Private sector participation. The proposed exploration license was facilitate, encourage, and incentivize the private sector in mineral exploration for critical and deep-seated minerals. The involvement of private agencies in exploration would also bring advanced technology, finance, and expertise in exploration, speeding up the process. Only 19 blocks of these minerals have been auctioned by the state government, with out of 107 blocks handed over to the various state governments. Authorizing the central government to auction concession for these critical minerals would increase the pace of the auction and early production of minerals. Reduced import dependency. In the long run, most of these minerals are largely import dependent. Hence, given the importance of critical minerals for economic growth, climate action, and national security, its exploration and judicious use are non-negotiable in the idea of Atmanirbhar Bharat. Okay, so there's an announcement to make. Today at 11 a.m. we'll be completing this whole PDF in one go in a 3 to 4 hour session, and I invite you all to come in and be with me and study and complete. If you have missed up till now, we can do that. So that's the scene right now. Of course, the August Vision magazine has already arrived, so we need to complete it. And today, in a 3 to 4 hour session, we'll be doing the same. And we'll be doing economy, security, we'll be doing economy, security, environment, and social issues in a 3 to 4 hour session. And maybe if we can club in science and tech and culture as well, then it will be cool. But if it becomes a huge stress, then we'll complete up till social issues in a 3 to 4 hour session at 11 a.m. dot. Thank you very much for being with me till the end. See you all next time.